All right, let's dive into rate cut season. Is this going to impact how the market is going? My name is Paul Barron. Welcome back into the show. Let's get into it. I do want to thank our sponsor, and that's Coinbase. They have a brand new offer out there for you guys. All you have to do is visit Coinbase.com, and the way it works right now is they've upped the ante to earn up to $2,000 when you buy crypto, and all you have to do is make a $50 purchase, and you're eligible for, I don't know if it's like a drawing or how it's going to work. They randomly select, but the point is, this is a benefit for you guys if you're brand new to crypto. Get over to Coinbase.com, use our link. It's going to help us out, and you can get started. Let's go into it today. All right, a couple things I want to hit on right now is U.S. Labor Department revises now, again, almost 1 million jobs out of the data that was reported over the past 12 months, ending in March 2025. This is bad. I think we kind of anticipated this. Is something I talk about often. I hit up about just bad data coming out of these government agencies. It, of course, now seems to be the point. I want to go to a clip real quick because this is the White House talking about this. Take a look.
White House Press Secretary Caroline Leavitt out with a long news statement on this. She says in full, today the BLS released the largest downward revision on record, proving that President Trump was right. Biden's economy was a disaster and the BLS is broken. This is exactly why we need new leadership to restore trust and confidence in the BLS's data on behalf of the financial markets, businesses, policymakers, and families that rely on this data to make major decisions. Much like the BLS has failed the American people, so has Jerome too late Powell, who has officially run out of excuses and must cut the rates now. So essentially, Carl, the White House here using this benchmark revisions report today to sort of bolster their argument and justify their firing earlier this summer of BLS Commissioner Erica McIntyre, saying that these, they said at the time the revisions were too large, that they needed to look closer at the data and see what was going on, why those revisions were so large. Now they're saying they were justified in doing that. That's why they need new leadership.
All right, so a lot happening out there in terms of jobs numbers. This is something I talk about for quite a long time, and that is I don't believe the job numbers have come out of our government, and this continues. I still wonder if the data that we're getting now is even accurate. It's possible it could be even worse than that, which would be catastrophic, and I think that's where we are right now, guys, in terms of the market, in terms of the economy, and I think the Fed, unfortunately, for whatever reason, I don't understand the point of why they aren't able to get to access data that's more efficient and more accurate. This, of course, has continued to push Powell in a direction that he really has no choice now. One other clip that gets into this is the tariff issue that's starting to play into this, because we still have inflation that could be affected by tariffs. And now we have this whole job loss. Take a look at this clip.
So we're talking about a revision of a revision from data from 5 months ago. I think that's why the market is not reacting. I think the rate picture to me is prepped for the fact that there is concern over the long end and that the short end is going down 70 to 75 basis points this year with another 25 next year. We've gone from a 2% of GDP tariff rate before the inauguration to a 15% rate. That's not nothing. And so the good news is that there is little more clarity on the horizon, that we're past peak, let's call it tariff temper tantrum. But, that's a 7 to 8-fold increase in some of the input prices that consumers and corporations are feeling. And I really don't think that's shown up in the numbers. I think we're looking at Q2, Q3, Q4, and the beginning of Q6 to see how that affects inflation.
So I am in agreement with that analyst in terms of where this could actually inflict pain on the market in general. I put out a tweet today that basically kind of outlines something that I think is important, and that is the China exports. This is down 33% in August. This is a kind of a desperate pivot, I think, of China pivoting to the EU. And remember, the EU is a very small part. You can kind of see the ASEAN, Chinese exports. That's, of course, the EU. There's China's exports to the EU. China's exports to the U.S., of course, falling off dramatically. This is just over the last little bit. So it's possible that these are going to start pushing hard into where the economy is going. Again, smart money still hedging against this into digital assets, but this could push us into maybe a short-lived tariff hit into inflation. The question is can Trump's administration pull us out of this through these rate cuts? That's the real I think, very tentative navigation that has to be done over the next 12 months. And a lot of this will lead to jobs and businesses getting confidence back in the market and the economy in general. BlackRock CIO comes in and says, hey, we need it bigger than 25 basis points. We need a 50 basis point cut. This is what I'm calling for. It's actually the one I was calling for in July, but I'm calling for it again in this month. And that is that a 50 is going to set the tone. And I think it will set the tone for multiple rate cuts as we go in. If you look at Polymarket, we'll just dive into the details right here. This is where we are right now. And I'm going to go down here and hover on the 50 basis points. As you can see, up to 15%. Just yesterday, that was at 10%. We are now at 15%. So if this is climbing by 5% a day, it's possible we could be over 50% before the FOMC meeting, which means it's possible we could see a 50 basis point rate cut. Further into Polymarket, the first time we've actually seen this, and that is 7 rate cuts. Let me kind of zoom in on that for you guys. We have now 8 or more, 7 or more, 6 or more, 5 or more starting to make the board, still holding with the winner right now at 3 rate cuts at 25 basis points right now for the year. So this will be a big one in the sense of how it plays into the markets. And I think all of what we're seeing out there is rate cut dependent. And the thing that's going to get hit the most off of rate cuts is going to be this right here, and that is money market funds. Eventually, the Fed fund rate will affect how banks and some of these institutions are paying people to keep their money in money market funds, which was still at one of the highest rates out there, maybe in the history of how money market funds are going. But right now, we have 7.4 trillion. That's up another 400 million or billion dollars in just a short period of time. This is a windfall, guys, into other components of investing. This will go into the stock market. This will go into gold. This will go into digital assets. The question is what percentage is going to start to navigate out of these money market funds into the market if we continue to see this push toward rate cuts. So all this, all depending on next week. One of the biggest FOMC meetings out there. We'll be airing it live for you guys. One other point I want to get at is these data problems, because this is going to be something that we got to fix. Take a look at this clip.
Maybe we can use AI. I don't know. How can we make it better?
I've always wondered why we can't have more accurate and timely collection of data from the states. And I think that has to do probably with new computers, new collections. That has always struck me. The other problem, Joe, is that to the extent that it's an estimate, we're always going to have problems with our models. This birth-death model that estimates the number of business creations and destruction, it's always a source of the revisions, and I don't know that they can do better than they've done. You could step back and say, if the average error on like 130 or 150 million jobs is 0.2%, maybe they're not doing that bad a job.
Okay, well, that's not the average error, because it's clearly the problem that we're dealing with right now is this corrupt data that's coming out. I don't know if it's politically charged data that's being manipulated or if this is really just that stupid. Either one is bad. I think maybe the being that stupid is probably even worse. But if you look at where we're going to be going in the future, you got to think about blockchain as the only solution for this. This would be an open network, being able to track real data, hopefully at the state level. That would be pretty cool. One of the states, if you're watching right now, I know Ron DeSantis watches our show, so Ron, let's get into blockchain data delivery, and then maybe you'll show other states how to get it done. Other things that you got to look for is October 21st. This is another one. This, of course, is the Fed hosting a conference on payments innovation. This will be interesting to see what the Federal Reserve does on that conference. This will be held on Tuesday, October 21st. All of this about innovation around a constant in payments, meeting changing consumer and businesses, but decentralized finance and stablecoin use cases are the key right there. All of this right into the wheelhouse of where crypto is going. Bitcoin's price prediction right now is being set at 200K, and that is coming, of course, with Fed rate cuts coming into this, and a couple of points in the article I want to hit on right here, and that is this statement right here. If you look at a certain amount of people considering where this is going from an analyst side, the nightmare scenario would be bulls would be a no cut at all, okay? And you could twist that and it would hit Bitcoin and tech stocks, I think, equally hard. That is a concern. I don't anticipate that that will happen, But if it were, you need to be hedged against that. So it's possible that Powell could actually not pull the trigger next week. And it would be tough on the Federal Reserve. I think that would really cause a lot of administration pain. But I think also if he only pulls the trigger on a quarter basis points, it might be just as bad. So I wonder if a quarter basis point is enough to move the market. Let me know in the comments down below if you think a quarter is best. Just put 2.5 yes or 50 if you agree with me, and I think that's 50 basis points. Congress advances their bill for a strategic Bitcoin reserve with seized funds. This could be good too because now Section 137 of the bill instructs Treasury to submit a report within 90 days detailing how this is going to take place. Could this be the potential of where we start to seize and some of these assets that are sitting out there, and we can get them on the book into the strategic reserve for things like Bitcoin and other digital assets to play into that? All this is good for, I think, market in general. One thing that's kind of unique is this headline right here, and that, of course, was Eric Trump downgraded to an observer with Alt5. Alt5, of course, tied into the World Liberty Finance thing. Company quietly revised its plan following consultations with NASDAQ. So it's possible we could see, this was in reference to Alt5 Sigma, really the company and tied to what we're seeing with World Liberty Finance. So interesting moves out there right now. Could be something else. Don't know. We'll keep a close track on this to give you guys some updates as we go forward. Robinhood may hit 160 bucks on 100% revenue growth by 2026. This is coming in from Bursane. Simply meaning Robinhood's got all the oars in the water. They are doing things the right way, even though I'm still at odds with Vlad about not launching banking and getting the credit card out to all of its users. Vlad, if you're listening and watching, we'd love to have you on the show. But the good thing is they have this going on right here, and that's the Hood Summit. So kicking off, this is going to be going with trading demos, lots of partnerships. They are definitely starting to, kind of project their inner spirit animal, as Vlad would say, meaning they're growing. And there's a big opportunity here. Crypto will be a big part of this, but this is more about other possibilities within Robinhood. Last up is Matt Hogan. He hits on something that's kind of interesting here, and I wanted to kind of press Matt on this idea. The scare articles about stablecoins destroying local lending markets is absurd. Now, his point is that, more importantly, the idea of credit will dry up if stablecoins compete with traditional banks. Classic first-order thinking. Yes, banks will provide less credit if they have fewer deposits. That is true. But instead, people with stablecoins will provide credit directly to borrowers through DeFi. That's going to happen most likely. I do see regional banks being impacted, but there is a solution here. So I kind of disagree with Matt in the sense that regional banks will be impacted, but there is a solution out there, and it's out there right now. If you look at this network, which is the Global Dollar Network, this is the stable coin that is a network-oriented stable coin, and look who is using this right now. You've got Robinhood, Kraken, Anchorage Digital, WorldPay, OKX, all these, Galaxy. Why not just layer in Fifth Third Bank, PNC, all of these regionals going into this and utilize stable coins and get into the game? That's the solution that banks need to be looking at right now. Hopefully the regional banks are listening to our show right now about that. But if they're not, that's okay, because you are, and you're ready to get moving in crypto. And the one way that you can do that is get in the Diamond Circle. The Diamond Circle is our own special group. It's private. You guys can join down below. It's absolutely free. I drop an email there each week kind of talking about where the market is, what my opinions are on where I'm going. You don't want to miss it. Use the link down below. Of course, follow me out there on X at Paul Barron. We'll catch you next time right here on The Paul Barron Show.